So how did that inform your development of a risk framework at the EIF?
Well, let's say the industry always wakes up to the question of risk when the regulator comes. And you have really certain waves of regulatory initiatives. In the early 2000s, it was Basel II, then later Basel III, then Solvency II after the Lehman shock. And then the industry suddenly becomes interested in the whole thing. But they always fear that once the subject of risk is touched, then it has very negative consequences for the industry. So the interest in looking at this, I think, from the point of the private equity industry is not always very strong. Regulators tend to, they understand that these are illiquid asset classes, but they tend to view liquidity or illiquidity in the framework of market risk. They see you can tackle your liquidity issues by selling an asset on the markets. Therefore, market risk figures very highly in this framework. But it's a little bit like these Inspector Clouseau movies. You know, Inspector Clouseau has his sidekick, Cato, and Cato has a standing instruction to attack Inspector Clouseau at any point in time. And
I live with two little Inspector Catos. Sorry, it's very dangerous.
Yeah, and which typically happens when he's under attack from some terrorists or criminals anyway. So for an illiquid asset class, this framework does not make a lot of sense. And I would say risk management in this area has most to add in under circumstance has most to add by protecting investors from selling off their assets and only sell them when there's really a profitable exit.
Yeah, but everyone looks through the other end of the telescope, don't they?
Yeah,
it's like you have to pay to be able to exercise your basest instincts and sell in a falling market.
Yeah, well, I mean, probably that is one of the greatest misunderstanding of this asset class, and that was essentially the insight gained through the work on Beyond the J-Curve, that venture capital investments on a diversified level are not as risky as perceived, provided that you are allowed to keep them over their full lifetime and only sell them off if it's really if the market is buoyant enough.